1.9 billion euros. That was the number on the balance sheet. The problem was, it didn't exist. In June 2020, one of Europe's most celebrated fintech companies collapsed overnight, wiping out billions in shareholder value and exposing what investigators would call one of the largest accounting frauds in German corporate history. This is the autopsy of Wirecard. Wirecard started as a payments processor in a Munich suburb in 1999. At its core, the business made sense. Merchants needed a way to accept credit cards online, especially in the early internet era when the major banks wanted nothing to do with gambling sites, adult entertainment, and other high-risk categories. Wirecard stepped in where the respectable players wouldn't. They processed the payments nobody else would touch, and they grew fast. By the 2010, the company had cleaned up its image, landed mainstream clients, and positioned itself as Germany's answer to Silicon Valley. In 2018, Wirecard's stock surpassed Deutsche Bank in market capitalization. The German establishment embraced it. It joined the DAX 30, the index of Germany's 30 most valuable companies. Regulators celebrated it as proof that Europe could produce a world-class fintech. The CEO, Markus Braun, dressed in black turtlenecks and spoke in the cadence of a visionary. He was, by every surface indicator, building something real. But underneath the glossy earnings reports, investigators would later allege the company had been running a fiction for years. Here is how the alleged scheme worked, explained simply. Wirecard claimed to process enormous volumes of payments in Asia through a network of third-party partners. Companies in the Philippines, Singapore, and elsewhere that allegedly handled transactions on Wirecard's behalf in markets where Wirecard didn't operate directly. These partners supposedly held the profits from those transactions in bank accounts, mostly at two Philippine banks. On Wirecard's balance sheet, those accounts showed a combined balance of approximately 1.9 billion euros. That money represented a huge chunk of the company's claimed assets and profitability. The auditors, Ernst & Young, signed off on the accounts year after year. The problem, which investigators allege, is that the money was never there. The Philippine banks later stated that the accounts shown in Wirecard's documents had no relationship to their institutions. The documents themselves, bank confirmation letters, trustee agreements, are alleged to have been fabricated. For years, a rotating cast of alleged co-conspirators allegedly moved fictitious balances around on paper, creating the appearance of a thriving, profitable global business, while the actual core payments operation struggled to generate sustainable returns. The Financial Times had been screaming about this for years. Starting in 2019, reporters Dan McCrum and Stefania Palmas published a series of investigative articles raising specific, documented concerns about Wirecard's accounting. The company fought back aggressively. Wirecard's executives called the reporting a coordinated short-selling attack designed to crash the stock. Germany's financial regulator, BaFin, did something remarkable. Instead of investigating Wirecard, it opened a criminal investigation into the FT journalists and the investors who had shorted the stock. Short sellers and journalists were cast as the villains. Wirecard's share price recovered. The company continued to raise capital from global banks and institutional investors. EY continued to sign the audits. And the 1.9 billion euros continued to sit on the books, untouched and allegedly entirely fictional. The unraveling came with a speed that still feels surreal. In April 2020, EY refused for the first time to sign off on the annual accounts. They said they could not obtain sufficient evidence that the cash balances at the Philippine trustee banks actually existed. Wirecard's stock began to fall. On June 18, 2020, Wirecard publicly confirmed what the FT had been reporting for 18 months. The 1.9 billion euros was, in the company's own careful language, likely not to exist. The stock collapsed. In 2 days, it fell more than 70%. On June 25, 2020, Wirecard filed for insolvency, the first DAX company ever to do so. The market capitalization that had once exceeded 12 billion euros was effectively zero. Within days, German prosecutors arrested Markus Braun. He has since been on trial in Munich facing allegations of fraud, market manipulation, and breach of trust. He denies the allegations. His former lieutenant, Jan Marsalek, the chief operating officer who allegedly oversaw the third-party payment network at the center of the fraud, vanished before he could be arrested. He is believed to have fled via Belarus with the alleged assistance of Russian intelligence, though those details remain murky and unverified. As of the time of this recording, Marsalek remains a fugitive. Interpol has issued a red notice for his arrest. He is, for now, simply gone, one of the most wanted financial fugitives in Europe, and a man who allegedly knew exactly where the bodies were buried. The aftermath has been crushing for the people who trusted the system. Retail investors, ordinary people who held Wirecard shares in their brokerage accounts, who believed the DAX listing and the EY audits and the analyst upgrades, lost billions. Institutional investors, including SoftBank, which had invested around $900 million in Wirecard structured notes, absorbed catastrophic losses. Thousands of employees lost their jobs. The German government faced fierce criticism for a regulatory failure of spectacular proportions, and BaFin itself underwent a significant restructuring in response. EY faced lawsuits from investors and administrators arguing the auditors either missed fraud that should have been caught or failed to apply sufficient skepticism to documentation that, in retrospect, looks obviously falsified. The trustee partners whose accounts supposedly held the 1.9 billion euros remain subjects of ongoing investigation. The full architecture of who knew what and when has not been completely established in a court of law. The trial of Markus Braun is ongoing. So what does the autopsy tell us about how money dies? It tells us that complexity is the oldest camouflage. Wirecard was not a simple Ponzi scheme where the math eventually collapsed on itself. It was a company with real operations, real products, and real clients, wrapped around a core of alleged fiction. The fiction was protected by the very institutions designed to expose it. The auditors, the regulator, the financial press's consensus, the DAX listing. Each layer of institutional endorsement made the next layer of scrutiny slightly less likely. The 1.9 billion euros didn't disappear in a single dramatic moment. If the allegations are proven true, it never existed at all. It was a number on a page, dressed in official letterhead, confirmed by signatures, celebrated by markets. The lesson is not that you should trust no one. The lesson is that trust without independent verification is just hope wearing a business suit. When the numbers seem too clean, when the growth seems too consistent, when the critics are prosecuted instead of investigated, those are the moments that deserve a second look. Because in the world of high finance, the most expensive lies are the ones that everyone agrees not to question.